Session here in Asia. Our guest today is Dariusz Kowalczyk, Chief Investment Strategist at SGS Markets in Hong Kong. Dariusz, always good to have you with us. I mean, pretty mixed session in Asia. China unwinding. There's growing expectation of a correction in the U.S. We're seeing weak numbers out of Germany. Can we expect some black days ahead in the market?
I think that fundamentally speaking, there is no reason to be too cautious because macroeconomic data around the world, in particular in Asia, continues to improve and will show further solid numbers when third quarter GDP data will be released, and I expect solid gains in growth across the globe. Having said that, the run-up in equity markets so far this year has been so strong that it's only natural for some players to take money off the table. But I think it will be used as an opportunity to buy by others, and therefore bleak days, I think, is too pessimistic a phrase to describe what is likely to happen in the near term.
Oh, you know me, I'm a bear, Dariusz. What do we do? What would you suggest investors do? Sit pretty on a pile of cash, look for safe havens like gold?
I think that looking for safe havens at this point of the cycle is probably not a very smart strategy. Volatility continues to be so high that you cannot really have, day-to-day or maybe even week-to-week confident bets. But in the near to medium term, say by the end of the year, I'm pretty confident that most risky asset classes will be higher than now. So I think we should remain overweight in assets such as global equities, commodities, maybe even corporate credit, and for sure emerging market assets.
A lot of people have missed out on the rally that we've seen recently. What should they be doing to catch up?
I think that there's not so much you can do to catch up because most of the gains that equity markets will show by the end of this year are already behind us. So the best strategy would be to maintain somewhat overweight position in equities, or if you are not overweight, you can still be calm, and look for opportunities in markets or sectors that show sharp corrections, because I believe such corrections are only temporary. For example, look at China. It is trading about 18–19% down from this year's peak. I think that valuations about 17.5 PE ratio for next year's earnings are quite attractive for that market. So I would definitely be long Chinese stocks.
But what sectors are you looking at? Any specific stocks, for instance, that you can suggest?
I do not look at particular stocks or sectors, but just from the broader macroeconomic perspective, given that recovery in Asia as well as in Europe in the second quarter of this year was driven surprisingly by the consumer as well as exports, I think those two sectors might be an interesting place to continue to be. But at the same time, a lot of the markets have seen improvement in macroeconomic growth because of a recovery in investments, such as Australia and Korea. In those two markets where confidence is high enough that investments are already increasing, companies from investment-related sectors are also likely to be solid bets.
How concerned are you about all the talks that China may switch its credit policy?
I'm not very concerned about that because policymakers there have made it clear that no major shift in whether we are talking about monetary or fiscal policy is likely in the near to medium term. In fact, when you look at the data about lending, the very low levels of new loans in July and probably August are likely to mark the bottom throughout the year, and probably starting in September, lending growth will be somewhat faster, about maybe 500 billion renminbi per year, which is likely to be supportive for the market.
All right, Dariusz, still to come more with Dariusz Kowalczyk, SGS Markets Chief Investment Strategist. Plus,